One of the most common questions that I get from traders is how to get started with Forex fundamental analysis. If you appreciate the importance of Forex fundamental analysis, and I think you do because you're watching my video, and you don't know where to start, you are not alone. Hello everyone, I'm Kathy Lee with BKTraders, and in this video, I will guide you through some tips on how to approach fundamental analysis and how to integrate it into your trading strategy. Now, if you aren't a subscriber to my channel already, I've got lots of great trading tips like this one, so make sure you do. It would be easy, of course, to say that a strong economy should equal a strong currency, right? And a weak economy or weakening economy should equal a weak currency. But it's not that simple because oftentimes when a country is slowing, it's not doing it in a vacuum. Oftentimes both countries are weakening or growing at the same time. How a currency moves will be determined by the relative pace of growth in one country versus another because currencies are traded in pairs and what that means for interest rate policy. The best way to approach Forex fundamental analysis is to imagine that you are a central bank governor, the Federal Reserve chairman, for example. What's important to you? What do you look at as metrics of how your economy, the US economy in this case, is doing? How does that affect your decision to raise or lower interest rates or nothing at all? You need to put yourself into the shoes of the central bank head because at the end of the day, the most important number one driver of currency movements and direction are interest rates. Large pools of money are basically moving from one part of the world to another and seek the highest interest rate or yield. So along those lines, what determines interest rates or yields? Well, it really boils down to three things in my opinion. The two most important are inflation and growth. Inflation is the rate at which prices are rising and falling. And when inflation is too high, central banks will try to limit the rise by raising interest rates. When inflation is too low, central banks may attempt to boost inflation by cutting interest rates. Now, there's a lot that goes on in growth, like business activity, consumer spending, the jobs market. The Federal Reserve in particular, although I think this is true of all the major central banks, really have one primary objective: to achieve the highest level of employment, maximum employment in their country without driving up inflation, with basically maintaining stable prices. Of course, finding that right balance is not an easy task, and that's why the big jobs. And for the long periods of time where there are no changes in interest rates, those are times when investors and traders are still thinking about who could be the first and who could be the last to raise or lower interest rates. And that's really the key. The expectations for interest rate direction is in many ways even more market moving and important than the interest rate changes themselves. The third most important factor that determines whether a central bank is more inclined to raise or lower interest rates is basically what is happening in the rest of the world. This is particularly important for countries that are export dependent, like Canada and Australia, who are particularly sensitive to the growth of their biggest trading partners. For Canada, it's the US. For Australia, it's China. I personally like thinking about Forex fundamental analysis in the context of the 3 M's. I think that will help you too. Macro, micro, and monetary policy. Now, you don't need an economics degree or to understand macro and economics. It's just another way of saying the big stories. These are stories that make it to the front page and not the business page newspapers. Things like COVID-19 pandemic, the attack on Israel, and the catastrophic tsunami of 2004, all of which directly affect growth. But macro is not just limited to these seismic events. Elections, trade wars, fiscal stimulus, Brexit are all examples of big stories that can drive the longer-term trend in currencies. If you notice, most of these are bad news. And when there's bad news, investors and traders will oftentimes sell first and ask questions later, particularly when those events are surrounded by uncertainty. Elections, in particular, could have longer-term ramifications if it also means major changes to trade or military policies. And there's also generally a lot of speculation built up ahead of these events, like elections or trade wars and fiscal stimulus. These events could create longer-term, multi-month trends. And as a trader, a smart way to use this fundamental information is to be aware of the broader fundamental story and then use your technical setups to look for opportunities to join the trend because these big stories are usually not resolved quickly. The second way to incorporate fundamentals is through microanalysis, which is a fancy way of saying analyzing economic data. Economic data tends to have a more short-lived impact on a currency. Even a big report like non-farm payrolls could fade in the market's mind in a matter of weeks or even days, because every month there's a new jobs report and every week there's a more up-to-date jobless claims report that could affect the market's thinking about what could happen next. Numbers like non-farm payrolls and even the inflation reports are great to trade on a short-term basis for a few hours or a few days of continuation max. The best economic trend trades are the ones that are consistent or reinforce the bigger macro or monetary policy stories. So that leads us to the third M, monetary policy. There's nothing more important than monetary policy because macro events can fade, just like investors panic and then focus on the recovery from earthquakes or the economic benefits of war. Monetary policy, on the other hand, changes slowly, and there's generally a lot of buildup before monetary policy changes, where central banks will give guidance. And if you remember, I said in the very beginning that Forex fundamental analysis all boils down to what central banks are thinking and doing. If central banks are at the cusp of lowering interest rates, everyone will be talking about who will cut first and who will cut the most. And the one who fits the bill will probably see its currency weaken the fastest. By the same token, the central banks that are most reluctant to cut interest rates, while everyone else is talking about lowering, will probably see more demand for their currencies. Now, you may be asking, Kathy, how in the world am I going to know this? I mean, this all sounds great, but how do I know what the market is thinking? Read. I don't expect you to be an expert at analyzing central banks, but read the ones that are. One of my favorites is ING Economics. I included their Twitter handle in the description of the video. They do a great deep dive and analysis before major central bank rate decisions. The bottom line is don't fade the central bank. If a central bank is looking to cut rates faster than its peers, use your technicals to look for opportunities to sell that currency. Avoid the trading signals that are telling you to buy in a rate cutting cycle. You can combine technicals and fundamentals in a number of different ways, either as confirmation signals, warning signs against taking certain trades, or a guide for the general direction of trades that you should be looking for. Regardless, learning about fundamentals will make you a better trader. If you're interested, I've got a course compiling a lot of my fundamental analysis experience that I also added in the description of this video. I hope you enjoyed this video. I hope you learned something. I will see you all next time.